The 10 Commandments, Monish Pabrai's Principles for Investment Management, a stock picker's perspective. Avoid costs. If you are picking stocks and not an investment manager, when buying funds or stocks, try to avoid brokers who charge high fees for the service. Likewise, if you manage a fund for others, be fair when charging them fees. Keep them as low as possible to keep your business running. Spend as little as possible in fees when buying stocks and funds. Some mutual funds charge a heavy annual fee. Index funds are usually cheaper since they don't require as much work. Try to keep annual cost of funds under 1%. Do it yourself. If you are managing some investments, regardless if they are your own or for other people, avoid hiring analysts or stock pickers. Such a practice will generate costs for you and your customers, which would cut into profits. If you have a friend who understands the same kind of businesses as you and who agrees to the same principles and is willing to base his or her salary on a small fee, then you might succeed, just like Buffett and Munger. However, there is no need for such partnership. Do it yourself and learn along the way, and you'll do fine. You will make mistakes. We are all fallible beings. Those who think otherwise are mistaken. During stock picking, expect to make mistakes at least 40% of the time. There are so many variables that we can't control. Macroeconomic factors could change the story. Some historical events may affect the company. A disaster may strike. The company's CEO might have cooked the books. You never know. Hope for the best when you choose a stock. Expect the worst. Don't overthink it. There are a few numbers you need to keep in mind when looking over financial reports of companies. According to Monish Pabrai, you should first look at the market capital of the company and then look at how much the company earned in the past year. Then try to figure out how much it will earn next year compared to the market capital. Everything above 10% is an interesting number. If you find a company you think will earn in 1 year an equal amount to the market capital, or even more, that's a potential multiplier. You can also look at the assets of the company. Sometimes the assets alone are worth more than the market cap, which could be interesting. When in trouble, distort reality. When a stock or even your complete portfolio goes down by a high number, the way you look at the issue may have impact on how you act. If you imagine a falling knife, you might get scared and sell out of your holdings. If you imagine a rope that will get you out of the deepest well, you might find hope and will patiently work yourself out of the trouble. Monish Pabrai mentioned that he used Excel not to evaluate businesses but to distort the reality, imagining that the current numbers were not real and instead working with more hopeful numbers. This helped him with patience, which is one of the most important assets you can have when your strategy is value investment. I remember Buffett and Munger talking about Berkshire Hathaway going down 50% in price, even though the fundamentals of the business hadn't changed at all. They knew this was an opportunity to buy. Currently, I've been buying Alibaba stock for a while, even though the news about its macroeconomic environment is horrible. My reality distortion field is using Excel to look at the actual numbers that matter, and I see that the business is going strong. So the temptation becomes buying more while it's cheap, since bad news never lasts forever. When Arjuna was being trained as an archer, his teacher told all his students that he was going to have a practical test for them. He set up a long pole. At the end of the pole, he put a sculpture of a fish. The fish had a tiny couple of blue eyes. Then he put the pole into a pool of water. He told the students to look at the water to see the reflection of the fish and the eye of the fish. They were to shoot the eye out. The first prince took his bow out and was asked by the teacher, "What do you see?" And the boy said, "I see the water, the pole, and the fish." The teacher tells him to sit down. He is not ready for the test. The second prince had the same experience, and this happened to all the students, one after the other, until it was Arjuna's turn. Arjuna stands up and he is asked what he sees. He says, "I can only see the center of the eye of the fish." His teacher tells him to fire at will. Of course he takes the eye out. Focus on the business. When you buy a stock, you need to know what to focus on. You should try to figure out its intrinsic value and its intrinsic value into the future, 5, 10 or 20 years from now. This means you see the growth and value in the same instance. You are like Arjuna, standing ready with a bow, and you aim for the value you believe it will have in the not so distant future. Don't worry about the price. The price follows the value. The value does not follow the price. Your target could be to buy the stock for 50% discount from the intrinsic value. Be patient. Keep learning. Stay focused. Shoot when you see the target clearly. Don't try to time the market. Shorting is one of the many methods day traders use to buy and sell stocks while timing the market. They bet on a stock price going down within a certain amount of time. If they are right, they make money. If they are wrong, they lose money. There are two reasons not to short. 1. The story can change overnight. And 2. You are timing the stock. The benefit of not shorting is that you buy when a story of a company is going strong over a long time, and you don't need to sell at any specific time. Even though some bad news pop up and the stock goes down, you can use that as an opportunity to buy more, since you expect that good news will eventually conquer. If you ever consider Warren Buffett's rule number 1 for investing, never lose money, then you will never short a stock. Avoid debt. Some brokers allow investors to take a loan for a stock. It can be marked as a leverage for 2x or 10x or even 100x, meaning that you are taking a loan and expected to pay interest on it. The higher the x, the higher the loan, and the higher the money you invest. Don't do it. Some companies have a high debt compared to equity. Unless you understand the reasons for the debt and you know the company will be able to pay it back without going out of business, stay clear of the company. The one way to lose all your equity in a company is when it goes bankrupt. Then your investment will go to zero. A company without debt is unlikely to go bankrupt, but it still can happen. For example, if they are found to have committed fraud. Avoid companies that are highly leveraged, that is, have a high level of debt versus equity. As a personal principle, I only invest in companies that have less debt than 50%. Lower than that is only a bonus. Debt-free companies are the most tempting buys. 20% debt doesn't worry me at all. Copy the best. Why not hire great professionals to do the hard work for you for free? If you wish to find a business to invest in, you can find out what great investors have been buying for the last 3 months. Study each of the company that interests you, and then invest in the ones that are in line with your principles and you see are cheap compared to their intrinsic value. Then just wait on the sidelines for a few years. Sell according to your own principles. You may be successful by simply cloning great investors, without thinking, and then waiting for a few years to sell. Investing isn't that hard. Subscribe and comment. Please tell me what I'm doing well and let me know how I can improve to make this learning experience about investing better for you in the long run.